Hi everyone, it's Professor Reiko here again today, going over an example of adjusting journal entries. So this is our 9th video in the accounting cycle. So videos 6, 7, and 8 focused on different types of adjusting journal entries. We have deferrals. So remember, just to refresh our memory, deferrals are when the cash comes first, and then we have the revenue or expense at the end of the period. We also had accruals. Accruals, remember, are when we're recording revenue or expense before the money has changed hands, before we've either paid or received the money. And then lastly, we had depreciation, which falls into the kind of like an estimate category. So what we're going to do now is just put them all together. So we're going to read through these examples. We'll identify whether we're dealing with a deferral, accrual, or estimate or depreciation, I should say. And then we'll go on and record the journal entry. All right, so just a couple things to keep in mind here. Notice we're doing these on 12/31/18, so I'm not going to write 12/31/18 for all the journal entries, but that's the date. All right, so let's start with this first one. Interest expense of $9,000 will be paid in January of 2019. All right, so remember, we are at 12/31/18. If you're a student that struggles with journal entries, which some students do, use keywords like will be paid. So will be paid tells me that we have not been paid yet, so that means somebody owes us that $9,000. So that should tell me we owe somebody $9,000. Therefore, we should have that expense and a payable. All right. So remember, this is going to be an accrual journal entry. Remember, with accruals, we're always going to have an expense and a payable, or a receivable with a revenue. Right. That tells us here it's interest expense. All right, so interest expense will be our debit. Remember, we always debit expenses for $9,000. Our credit is interest payable of $9,000. Like I was saying earlier, this will be paid. It makes sense that we have a payable, all right, because we are going to pay this in January the next month. But remember, the whole point here is this expense is in 2018. Right. So therefore, by doing this journal entry on 12/31/18, it is getting recorded in the correct year. Now the cash is going to change hands next month, but that's a whole different year as far as our accounting cycle goes, and that's fine. But we want the expense recorded in 2018. All right. On the flip side, we have interest revenue. All right. So notice here, has been earned but not received. All right. So that not received should tell us we're going to have a receivable. All right. Once again, this is another accrual journal entry. All right. So this is the revenue side. So we're going to have a receivable with a revenue. So we're just going to have interest receivable of $4,300 and interest revenue of 43. So once again, this revenue has been earned, as it says. So we want this revenue in 2018. On our 2018 income statement, we want to reflect that revenue relates to 2018. And once again, when we see this not received, it makes sense that we have a receivable in our journal entry. All right, so let's keep moving along here. So notice the dates here. Always pay attention to dates. This is July 1st. We collected $13,900 rent in advance and debited cash and credited unearned rent revenue. All right, the amount was for 2 years rent. All right, so this isn't the answer, but let's just go on and jot down what they did on July 1st. We have a debit to cash and a credit, I'm going to abbreviate, to unearned rent revenue of $13,900. All right, so that's correct. That's what they did, right? What we want to do here is have the adjusting journal entry on 12/31. Okay, so let's kind of walk through here. It says it's $13,900 and it's for 2 years of rent. All right, so that equals $6,950 per year. All right, so if we look at our time frame, remember over here I said let's make sure we pay attention to the date. We're July 1st and we're going to 12/31, which means half the year is gone, or 6 months. Okay, so we can multiply this times 1/2, divide it by 2, whatever you want to do, to get what it is for 6 months. So it's $34.75 for the 6 months that we're dealing with here. All right, so my journal entry. So remember, this is, I probably should have started with this. This is a deferral. Remember, deferral, cash comes first, which it did, and then the revenue or the expense comes later. All right, so my journal entry now is, and remember, this account right here is a liability. Unearned rent revenue is a liability. It's not earned yet. It earns as time passes and we fulfilled our obligation to whatever is being rented. So after 6 months, we have met 6 months of our liability, of our obligation. So this is going to reduce the liability. And then we're going to go on and instead of unearned, it's now just regular rent revenue. Remember, this will go onto my income statement. And if you think about the unearned account, let's just draw a T account over here. So we started with $13,900. And we just had this debit of $34.75. All right, that gives us a balance of $10,525, which reflects the difference. That this reflects the other 18 months we still have to go. Now, some of you may be arguing, saying, "Hey, we should probably do this journal entry right here every single month," and that's fine. That's correct. You could do one every single month. In the example that we did in the deferral video, that's exactly what we did. We just did it on a monthly basis. However, just always pay attention to what your teacher wants in your class. Sometimes they may want it monthly, or sometimes they may want you to do it like this, just so you have one journal entry summarizing the 6 months. So just make sure you always know what your teacher is expecting out of you. All right, so a few more. All right, so this one, salary expense is $1,300 per weekday, and payday is each Friday. Okay, so they get paid $1,300 a day, and we pay them on Friday. So 12/31, the end of the period, is a Wednesday. Okay, so what that means is Monday, Tuesday, and Wednesday is part of 2018. So that's what we're concerned with here. All right, so we want to say, all right, they make $1,300 per day times 3 days in 2018. Now, Thursday and Friday, we're going to pay them for that, but that's a different accounting cycle, a different accounting period. All right, so that's going to be equal to $3,900 that relates to 2018. All right, so what we're going to have here, and this is also an accrual journal entry, because we're recording the expense or the revenue before the cash changes hands. All right, so what we're going to do here, so remember, with accrual journal entries, we're recording the expense or the revenue in the correct time period. And if it's the expense, it's always going to be an expense debit and a payable credit. So we have salary expense and salary payable for $3,900, and that would take care of that. So once again, this now is getting recorded in 2018. This payable reflects that we owe them, and we will pay them on Friday, just like we do every other period. Now look, the Thursday and Friday that we're still missing here, the other $2,600 for Thursday and Friday, that will be basically another salary expense for the $2,600, but that's going to be part of 2019. So remember, we're just wanting to make sure that we put everything in the correct time period. All right, our next one, supplies account. So supplies, remember, falls into that deferral category, meaning cash comes first. We've already bought the supplies, and then we're going to expense it at the end as we use them up. All right, so it says supplies account had an unadjusted balance of $2,900 and $1,600 is on hand. All right, so what that means is, let's just sketch out a T account here. The unadjusted balance, so it's a debit. It's a debit balance because it's an asset. Is $2,600. I'm sorry, that's $2,900. And the ending balance is $1,600. All right, so notice I knew to put both of those as debits because it's an asset account. All right, so what we're saying is we start with $2,900 and we only have $1,600 left. If that's the case, that means we used $1,300 of our supplies up during the period. So that's what we want to expense, because when we're doing these deferrals, we're expensing what we've used up. All right, so we're going to debit supplies expense and credit supplies for $1,300. Once again, that credit to supplies is that credit to supplies right there. All right, our last one, we have equipment costed $140,000, was purchased on January 1st. So that's the beginning of the year. The equipment has a useful life of 5 years and no salvage value. So obviously this is a depreciation example. So the first thing we need to do is calculate our straight line depreciation. So remember, it is historical costs, which is $140, less salvage value, which is given as 0, divided by our useful life in years. All right, so that means we're going to have $28,000 per year. That's the annual amount. Notice this was purchased on January 1. We're now at 12/31, which means we are recording a full year's worth of depreciation. So my journal entry for depreciation is always debit depreciation expense and credit accumulated depreciation for $28,000. If we wanted to keep up with the book value of the asset, remember, book value equals historical costs less accumulated depreciation. So historical cost was the 140. We've now depreciated 28, so we can get our book value, which would be the number that goes on in our balance sheet that gets added to total assets. All right, so hopefully this is an example that helped kind of reinforce what we've already done in the prior 3 lessons. It's always good to kind of have an example to do a few more journal entries. So make sure you practice these and have a pretty good grasp on these, because this chapter is extremely important for your success in the rest of the your intermediate series. So hopefully you've enjoyed this. Please subscribe to my channel. Feel free to share this with friends that might be struggling in this area. I hope you've enjoyed it, and hope you tune in next time. Thanks.